At 1:45 in the morning, before most of the world woke up, a single decision shattered global confidence. A 158-year-old Wall Street institution filed for bankruptcy. Phones rang across trading floors. Screens flashed red. Banks stopped trusting banks. Within hours, trillions of dollars froze in place. Credit markets seized. Money, the lifeblood of the global economy, stopped flowing. This was not just a corporate failure. It was the moment the financial system realized it was standing on borrowed ground. This was the fall of Lehman Brothers, the collapse that turned a financial downturn into the worst economic crisis since the Great Depression. Lehman Brothers began far from Wall Street. In 1850, Henry Lehman, a German immigrant, opened a small dry goods store in Montgomery, Alabama. His customers were cotton farmers. When farmers couldn't pay in cash, they paid in cotton. That cotton became currency. But the business evolved from retail into trading. Henry's brothers joined him. Lehman Brothers was born. By the late 1800s, the firm moved into commodities brokerage. By the early 1900s, it was financing railroads, manufacturers, and retailers. Lehman helped fund companies like Sears and Woolworths. The firm survived the panic of 1907. It survived the Great Depression. It survived 2 world wars. For over a century, Lehman adapted to every financial era. Its reputation was built on resilience. Its name became synonymous with institutional permanence. By the 1990s, Lehman Brothers was a modern investment bank, publicly traded, highly leveraged, and deeply embedded in global capital markets. Its survival history created confidence. That confidence would later become a liability. To understand Lehman's collapse, the environment matters. In the early 2000s, interest rates were historically low. After the dot-com crash and the 9/11 attacks, central banks flooded markets with cheap money. Borrowing became easy. Risk appeared manageable. Housing prices rose steadily. Banks discovered a powerful mechanism: securitization. Instead of holding mortgages for decades, banks bundled thousands of loans together and sold them as bonds. These were mortgage-backed securities. The risk was spread across the system, or so it seemed. Rating agencies labeled many of these products as safe. Institutional investors worldwide bought them. The financial system rewarded volume, not caution. More deals meant more fees. More leverage meant higher returns. This was the system Lehman aggressively embraced. Lehman Brothers did not merely participate in the housing boom. It specialized in it. The firm expanded its mortgage division rapidly. It acquired lenders. It bought real estate assets directly. Unlike some competitors, Lehman retained large portions of its mortgage exposure instead of selling it all. This amplified profits and risk. From 2003 to 2007, Lehman's balance sheet exploded. Assets grew from roughly $300 billion to over $680 billion. The leverage ratio climbed beyond 30-1. That meant a small decline in asset values could erase shareholder equity. Yet profits surged. Executive compensation soared. Shareholders were rewarded. Internally, risk models relied on historical data. Nationwide housing declines were treated as nearly impossible. The assumption was simple: housing prices might slow. They would not collapse everywhere at once. This assumption shaped every major decision. Lehman was deeply involved in collateralized debt obligations, or CDOs. CDOs repackaged mortgage securities into layers called tranches. Top tranches were labeled low risk. Lower tranches absorbed losses first. On paper, diversification reduced risk. In reality, the assets were highly correlated. When homeowners defaulted, losses traveled upward. Lehman used its own models to assess risk. Those models relied on stable housing markets and liquid credit. Both assumptions would soon fail. By 2006, U.S. housing prices peaked. Subprime defaults began to rise. In 2007, 2 hedge funds at Bear Stearns collapsed due to mortgage exposure. The signal was clear. Some banks reduced risk. Lehman increased it. The firm believed markets were overreacting. Executives viewed the downturn as temporary. Lehman doubled down on commercial real estate, office buildings, hotels, development projects. These assets were liquid. They could not be sold quickly without massive losses. The balance sheet became heavier. Liquidity quietly weakened. Scrutiny increased. Lehman used short-term transactions known as Repo 105. These deals temporarily removed debt from the balance sheet just before reporting periods. Leverage appeared lower. Risk perception improved. Legally complex, technically permitted, economically misleading. Once the reporting period ended, the debt returned. Nothing fundamentally changed. Markets relied on reported numbers. Confidence remained for now. In March 2008, Bear Stearns collapsed. The Federal Reserve arranged a rescue. Markets learned an important lesson. Some institutions were considered systemically important. Lehman assumed it was one of them. Its stock price fell sharply. Credit default swap spreads widened. Counterparties demanded more collateral. Liquidity, not solvency, became the threat. Lehman still had assets, but assets don't pay bills if they can't be sold. Throughout mid-2008, Lehman searched for buyers. Talks occurred with Korean banks. Negotiations stalled. Losses mounted. Confidence deteriorated further. In September, Lehman reported 3.9 billion Australian dollars quarterly loss. The market reaction was brutal. Bank of America considered acquiring Lehman, then walked away. Barclays showed interest. Regulatory obstacles emerged. Time ran out. U.S. regulators convened Wall Street executives in New York. The goal: engineer a private rescue. Unlike Bear Stearns, no government backstop was offered. Political pressure had shifted. No firm agreed to absorb Lehman's losses. As negotiations failed, confidence evaporated. On Sunday night, Lehman Brothers prepared bankruptcy filings. At 1:45 a.m., Lehman filed for Chapter 11. Markets opened in panic. The Dow plunged. Money market funds faced runs. One fund holding Lehman paper broke the buck. A symbol of safety collapsed. Interbank lending froze. No one knew who was exposed. Fear replaced analysis. Lehman's failure was not isolated, exposed the fragility of the entire system. Within days, aid required an emergency bailout. Global banks teetered. Governments intervened on an unprecedented scale. Trillions were committed to stabilize markets. The crisis spread to Europe. Banks failed. Sovereign debt crises followed. The global economy contracted sharply. Millions lost jobs. Closures surged. Retirement savings collapsed. Global trade declined. Entire industries slowed or disappeared. Lehman's bankruptcy became a symbol, not of one firm's failure, but of systemic excess. In response, governments rewrote financial rules. Capital requirements increased. Stress tests were introduced. Derivatives markets became more regulated. Risk oversight expanded. Banks were labeled systemically important. Failure was no longer supposed to be an option. Lehman's shareholders were wiped out. Executives lost equity but avoided criminal charges. Some competitors survived through government support. Others vanished entirely. The financial system survived but permanently altered. Lehman Brothers did not collapse because of one bad quarter. It collapsed because risk was misunderstood, leverage was normalized, and confidence replaced caution. Its failure revealed how fragile modern finance had become. When trust breaks, markets stop functioning. Lehman's name disappeared. Its lesson did not. Because in global finance, survival is not about size. It is about liquidity, trust, and knowing when growth becomes danger.